Hello everyone, welcome back to Market Dialogue. This video is a part of educational series where we decode the market from a smart trader's perspective. Let's begin. Last month, I had posted an educational video on Nikola Tesla's quote that is, if you have to find the secrets of the universe, think in terms of energy, frequency, and vibration. Likewise, we had discussed in trading how energy can be the money, frequency could be the time factor, and of course, vibration shall be the price action of charts, and also in case of a trader. Following up on Tesla's universal laws, today's episode shows you how the energy or money in the markets doesn't just appear, it builds, accumulates, and transforms trading outcomes over time at critical price points. We will break down how these flows can be tracked on real charts, how market entities are interdependent, and how you can use this powerful relationship for a smarter and more consistent trade decisions. First, let us discuss how energy or money improves over time with respect to price action. Let's start with the foundation. When you are trading, energy, which is expressed as money or the capital, reveals itself in price action. But this isn't it all. It is also a product of time consumed across a particular price behavior. For example, if you look at higher time frame charts like dailies or weeklies, or let's take an hourly chart for example, you'll notice that for a maximum number of candles, the beginning of the trend will not be revisited for a long time. Suppose it is in the case of an uptrend. There will be a lot of call buying for many months in similar cases. So, the more time taken with the specific price action shall signify the major money that can drive the price down sooner or later with the help of strong call writers and hedge funds. Hope you are all following. Being the market dialogue community, we have principles of interconnecting concepts of money, time, and price action, and nothing else. More and more higher highs without breaking the swing lows over a long period of time show too much money to be exited in favor of smart traders. Whenever there is a scenario of most of the price action terminologies like price patterns, triangles, liquidity graphs, channels, all are different forms of energy accumulation or money building up. They are simply there to make the trader feel off track and unworthy. Let's see how price action can be linked to energy. What does price action reveal about money flow? Consider this. Each chart pattern, flags, triangles, and consolidations are a snapshot of energy being stored or released. When the price spends a lot of time during a breakout, it reflects money entering the market. Energy is manifesting as a powerful trend. Conversely, consolidation is the energy which is waiting to strike. Let's highlight this with a real chart. Look at this tight range. Here, there is a lot of call buying. When hedge funds and call writers enter subsequently, every retailer who had invested in buying calls will have to face losses. Both price and time taken have worked in unity, confirming money or energy accumulation. Right? Recognizing this pattern helps traders enter before the crowd and exit before reversals. I'm sure most of the viewers have already come across numerous trading indicators and patterns of candlesticks. All of these mostly derivatives of money, time, and price action. Take volume profile indicators. What is that? It is the amount of money accumulated at a particular price point for a certain duration, isn't it? At the end, here's where your connections become very clear, right? Price, volume, and time are mutually reinforcing entities. If you want to talk about volumes, that is another important entity in trading, are also a form of energy, correct? Money, price action, and time factor are the DNA of trading. From Fibonacci to Elliott waves, Wyckoff to smart money concepts, everything is related to the energy, frequency, and vibration of charts. When you understand these dependencies, your decisions become clearer. For instance, don't rely solely on a so called indicator because 99% of indicators are freely available to each and every retail trader on the planet. In that case, the smart or institutional trader with huge investments and resources is highly confident because his algorithms and research team are so advanced that they can track every retail move that relies only on indicators most of the time. If all the threes align and you find reasons for the next move, the probability of a successful trade is much higher. This multi-factor approach helps manage risk as divergences warn you to avoid or exit trades. A good process involves layering your technical analysis. At first, start with money flow analysis, confirm with the price action, and add context from higher to lower time frames. And only then commit with your capital with a stop loss. In order to conclude the video, I would sum up energy or the money flow is not static. They evolve with time and price action, which is guided by the interplay of dependent market entities. Use these relationships to refine your decision making. Wait for the alignment, be patient, and trade with confidence. All right, let's wrap this up. Remember, your trades are your responsibility, not mine, not anyone else. Learn to read the market, don't just react to it. Take time to review what we covered today. Go back through your own charts and look for these money, time, and price action combined patterns. Mark the analysis. Watch what happens next. Understanding energy, frequency, and vibration of charts is understanding the market. Once you see it, you can't unsee it. I'll see you in the comment section. Share your thoughts, your questions, your own observations, and I will see you in the next week's session where we will dive into specific setups we can discuss now and even more for the upcoming week. Until then, decode the market, trade with clarity, and remember, it's market dialogue, not market noise. Thank you for watching.